This is Bloomberg Daybreak Middle East and Africa, our top stories this morning. Strong U.S. factory data pushes markets to rethink the number of Fed cuts this year. Odds of a June cut now dipping below 50%. Iran says an Israeli strike on its embassy compound in Syria killed military generals. This as Israel agrees to in-person talks with the U.S. over an invasion of Rafah. And Turkish President Recep Tayyip Erdogan suffers an historic defeat at the ballot box. Support for the ruling party now at its lowest on record amid high inflation and borrowing costs. It's just gone 8 a.m. across the Emirates. I'm Bonnie Quinn in Dubai, and let's see how we are shaping up for the Tuesday session. Of course, markets closed in several areas across Asia yesterday. Not so in the U.S., though. It was a very muted session in spite of that very strong manufacturing data. As you can see, futures are pointed to a lower open, just marginally, though. Yesterday, the S&P 500 and the Nasdaq 100 both down just about 0.2% on the S&P, up just about 0.2% on the Nasdaq 100. So very muted reaction, really, to the ISM manufacturing data. Traders in the bond market, though, different story. Repricing the amount of Fed easing priced into swaps contracts this year to around 65 basis points. That's less even than policymakers are forecasting. And it also seems like June might be out now, or at least there's a lot less of a chance of a June cut. That's being shifted into July or September. As you can see, the two-year yield jumping about 10 basis points. It was that across the curve, really, a 10 basis point move. Strong China data as well, continuing to push Brent crude prices higher. We're approaching $88 a barrel now. So let's flip up the boards and see what we have going for us in our next section. The Nikkei 225 unchanged, this after a big drop yesterday. We did see it come back a little bit today. The Hang Seng, though, a very different story, up 2.4%. And then in China, well, again, a lot more muted, even though we had that better PMI helping things along yesterday. The yen, 151.75. We're approaching 152, but, you know, we're still a good 25 ticks away from that. Let's have a quick look at that manufacturing data, though, because look at this. It's rebounded into expansion territory for the first time in 16 months. So you can see why that's giving traders pause. Also, Jerome Powell, I'm sure, he'll be speaking Wednesday, so we'll get something more from him than the narrative that was last week, which was patience at the Federal Reserve. So again, the strong factory data prompting traders to price in less monetary policy easing by the Fed this year, briefly setting the odds of a first move in June below 50%. Markets also considering cautious comments by Fed Chair Jerome Powell Friday.
The report that came out this morning is pretty much in line with our expectations. We're making progress. This is good, but we need to see more. The decision to begin to reduce rates is a very, very important one. The economy is strong. We see very strong growth. We had growth for last year over 3%. We don't need to be in a hurry to cut. It means we can wait and become more confident. I don't think rates will go back down to the very, very low levels they were at before the pandemic. This economy doesn't feel like it's suffering.
Let's get more now from MLive strategist Mark Cranfield. So, Mark, the messaging had been very much last week, patience, patience, patience. Why is the Fed still predicting 3 cuts this year, then?
It's going to be very tough for them to hold that line by the time they come to the June meeting. If you look at the ISM data that we've had this week is extremely strong. We've got the non-farm payrolls coming out later in the week as well. The consistent theme is that inflation's coming down, but it's not really meeting their target just yet. So there are a number of reasons why it's beginning to look unrealistic for the Federal Reserve to expect 3 interest rate cuts this year. And as you were saying, the market is beginning to see that as well, and it's taking out some of those expectations. If the data continues in the direction it has been going, the Fed will have to adjust its dot plots to just 2 interest rate cuts when it announces it in June. And the market is getting ready for that. And obviously the implications, especially for the bond market, is that yields probably need to rise a little bit higher, and is keeping the US dollar very strong.
Yeah, market moves are really just fascinating. And I guess when the Fed does start an easing cycle, it doesn't want to have to reverse course or pause. It would be better if it was able to just continue on. What about the yen, Mark? Because we have been sort of flirting with that 152 mark for some time, but I guess 25 ticks is as far away from 152 as authorities need to see, right? It's not in any danger right now?
There's huge speculation about where is the level where the yen becomes uncomfortable for the Japanese authorities. whether it's at 152 or somewhat higher, the market is continuing to push in that direction. And as we've been saying, it's this difference between the path of the Fed and the Bank of Japan. If the US interest rates are going to stay higher for longer and the Bank of Japan is going to be very slow in changing policy, that obviously lifts dollar yen. Really now it's almost like a game of chicken. You can see that the market, the leverage traders are very short of the Japanese yen. They expect it to get weaker in the near term, and yet you're getting a fairly steady flow of Japanese voices giving verbal intervention to remind them they don't want the yen to get too weak. At some point, something will break. And looking at the tactics the Japanese authorities have used in the past, they will probably allow dollar yen to go above 152, let the market get overconfident, and then they will come in to strengthen the yen. That's how they did it in October 2022, and it was very successful. So trying to defend a specific line in the sand for dollar yen is probably just going to increase the speculation. So more likely they'll sit back and they'll let the market get into a bit of a complacent attitude, and then we will see the Japanese authorities come in.
Yes, it's a game of chicken, as you said. A lot of strategy going on at the Bank of Japan and, of course, the Ministry of Finance as well. Bloomberg MLive strategist Mark Cranfield, thank you so much. Let's bring in Nadia El-Balassi now, market analyst at Equity Group, who joins me here on set in Dubai. So, Nadia, of the events that we've been talking about, so repricing for Fed cuts and, yen weakening, what's most important for your clientele right now?
I think that the Fed pushing back on rate cuts is really important because we're seeing a lot of volatility go into safe haven assets. Our most traded product, gold prices, have soared, almost going to break 2,300. So I think we're focusing on that right now. Commodities as well, from a contrarian perspective as well, that they all said that it's going to surpass 2,300, and we're just waiting for that pivot level to happen.
So when you talk about commodities as a hedge, are you specifically talking about gold, which is doing well, it's been hitting records, or are you looking at other commodities too? I mean, oil continues to strengthen, but maybe not for the best reasons?
Yes, we're also obviously looking at oil prices. I mean, we're seeing really, solid territories for it to go higher, but we have very, good fundamental reasons for that. The Red Sea issue, and also the Russian refineries getting hit. So there's a lot of factors contributing to oil prices, but gold and the dollar as safe haven assets really going higher together, usually uncorrelated, but at this phase of time correlated together. We are focusing on these both two specific assets in particular.
One of your other contrarian calls is China tech, which I thought is interesting because now seems to be a pivotal point. Perhaps investors are starting to think about getting back into China, but we've thought that how many times in the last 12 months, only for them to disappear again after making a little bit of profit.
That's true. It's hard for investors to get back into China as an emerging market right now. However, being at discounted valuations, it really seems intriguing for investors. So I think even last week we saw an uptick in Chinese markets. So yeah, I would say that there's definitely an opportunity to buy when we see that higher valuations are turning into discounted rates. So there's obviously an opportunity there as well.
And would it be specifically China tech? Would it be sort of Hong Kong tech? What would you be looking at?
Yes, I would say Asian markets in particular, but definitely with a focus on Chinese equities. But we are seeing definitely a lot of higher volatility also in the Nikkei, for example, in Japan and the developed world. So I would say both, or Asian markets in particular.
Now, one of your other conviction calls, which I thought was interesting, is Bitcoin surpassing $100,000 a coin. Now, we're already into March, and we're looking at the halving in April, and typically Bitcoin goes down before the halving. And we have seen it sort of retreat a little bit. So what gives you this conviction that we might see 100,000 this year?
I mean, we've been talking about this for the past year. We said that Bitcoin's going to surpass 60, then it's going to surpass 70, and we're going in that direction. And I think that with the halving happening, it gives traders an opportunity there. And after the spot ETFs to be, given the green light, also it's another factor to motivate investors to put in their money into cryptocurrencies. And I think that we've seen a lot of inflows into cryptocurrencies already. So this is why it's one of my conviction calls.
Geopolitical concerns, I mean, it's obviously huge in this region. It doesn't seem to have impacted markets quite substantially yet, though. Will it still? I mean, we are seeing it a little bit in the oil markets today, but how does that play into your thesis?
I think local markets are moving in line with international markets, especially the U.S. markets. And as long as that's going higher, driven by factors like rate cuts or earnings or, less geopolitical risks in the U.S. and also ahead of the elections, Trump elections, in that direction, then the local equity markets also going to follow that great optimism, especially that a lot of, like the UAE local markets, attracting a lot of foreign investments, whilst other, for example, China's economy or elsewhere emerging markets are losing on that steam, like South Africa. So we're seeing inflows in local equities over here.
Now, I know that you were convinced that Trump will win the election this year. If that happens, what happens to equity markets, not just locally, which you say, it'll be good for local equity markets, but, more broadly?
Broadly, I think historically we've seen that by leading up to the elections, we already see a lot of higher volatility in the equity markets. So I think with Trump, given the history of things, things usually get really volatile. Just a tweet from Trump, just like how Musk is dealing with equities right now and how volatile things could be. For Trump, it's the same, especially as he gives us like contradicting tweets or something, but he really creates that type of volatility to spike it up. And I think markets would be like loving that.
All right. Thank you so much, Nadia, for joining us today, particularly in studio. That's Nadia El Balassi, market analyst at Equity Group. Still ahead, hear why Emirates NBD remains overweight Japan, India and select tech and healthcare sectors. Plus, Iran says an Israeli airstrike has killed 2 military generals, the latest on risks from conflict in the Middle East. That's all coming up on Daybreak Middle East. Welcome back to Daybreak Middle East and Africa. I'm Vonnie Quinn in Dubai. Iran and Syria say an Israeli airstrike on Tehran's embassy compound in Damascus has killed several people, including 2 military generals. Iran's foreign minister says Israel should be held accountable for the repercussions of the attack as tensions grow between the longtime adversaries. Bloomberg reporter Bruce Einhorn joins us now. Bruce, can you give us some more context on this attack, what actually happened?
So, Vonnie, so far we've heard from both Iranian and Syrian media saying that there was an Israeli attack on the embassy compound, the Iranian embassy compound in Syria, that a top general who is from the Islamic Revolutionary Guard Corps was killed, including as well as several others, including another general. Israel has not confirmed this. This does come after there were attacks, an attack last week that led to dozens of people being killed, including Hezbollah members. That was something that Syrian state media said that was the result of an Israeli airstrike. Fonnie.
Yeah, we'll have to see where that goes, Bruce, and whether there'll be some kind of a retaliatory attack or whether it will remain just words and verbal sort of warnings. What about Rafah? It looks like now there might be some kind of a chance that conversations are taking place and that might actually lead somewhere. Up to now, that seemed a little bit less likely.
There was a meeting, a virtual meeting, that U.S. Secretary of State Antony Blinken, U.S. National Security Advisor Jake Sullivan held with their Israeli counterparts. That lasted for about 2 hours. This came after there was supposed to be an in-person meeting that got called off by the Israelis following the United States decision to abstain at the Security Council at a vote regarding a call for an immediate ceasefire and an immediate release of hostages. As a result of this virtual meeting that now has taken place, there will be follow-up meetings, including meetings in person, possibly as earlier as next week. This all comes at a time when there are disagreements between the Americans and the Israelis about attack on Rafah, about the protection of civilians there, of refugees there. There are about a million people from other parts of Gaza who have taken refuge in Rafah, which is in the very southern part of the Gaza Strip. And so what happens next, we'll see in part by what comes out of these negotiations, these talks between the Americans and the Israelis.
All right, Bruce, thank you so much for keeping us up to date continually. That is Bruce Einhorn there with the latest on Israel-Hamas. Turkey's President Recep Tayyip Erdogan has suffered an unprecedented defeat at the ballot box to the main opposition party. Poll results show voters turning against his ruling party as the nation battles rampant inflation and high borrowing costs. Turkey economy and government reporter Beryl Akman joins now. Beryl, what is the importance of this decision? What does it mean for Erdogan?
I think, like all elections, this was a test on President Erdogan's popularity. But it comes just 10 months after the president was re-elected and the opposition and allied opposition was defeated. And now it looks like people are protesting against the economic downturn that they have suffered in recent years, with inflation soaring and a lot of millions of households experiencing cash trap and the worst cost of living crisis. So it's really an unprecedented, like you said, loss for President Erdogan. And he said for the next 4 years, where there's no election scheduled, he'll use this period, him and his party will use this period to reassess what happened. It is also historic for the opposition, which rarely lands a victory against Erdogan and his party. And it really dents the shield of invincibility that President Erdogan has created in the political sphere.
Well, exactly. So you have to wonder what it will mean for Erdogan and the opposition. Will the opposition be able to take advantage of this somehow? Will Erdogan try and crack down a little bit more, or will he turn to, something a little bit more attractive, let's say, to voters? How does he play this?
Those are great questions. I think we've seen the opposition win key cities like the country's financial hub, commercial hub, Istanbul, and the capital, Ankara, in the local elections in 2019, which were also rare victories for the opposition. But just 10 months ago, like I said, there was an opposition of 6 parties united against President Erdogan, and they still were defeated. So I really we'll have to watch and see how the opposition takes advantage now of ruling both the strongholds that the AK Party, President Erdogan's AK Party had, as well as the key cities like Istanbul and Ankara this time. Istanbul's mayor, Ekrem İmamoğlu, is actually facing a legal case on allegations that he insulted the election watchdog in the 2019 election, when the watchdog did not accept his initial victory and the vote went for a repeat. Now, İmamoğlu, the mayor, has his next case scheduled on the 25th of April, and he's facing a political ban. So there's that risk for the opposition as well.
Well, we have the lira at 32.27 right now. It's been weakening pretty chronically. We'll continue to keep an eye on this story. Turkish economy and government reporter Beryl Akman, thank you so much. Plenty more ahead. This is Bloomberg Middle East and Africa. Stay with us. Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Vonnie Quinn in Dubai. The RBA is set to switch to a new framework for the implementation of monetary policy. The Assistant Governor for Financial Markets, Christopher Kent, outlined the changes in a speech at Bloomberg's Sydney office. Earlier, he spoke to us about the outlook for the central bank's policy settings.
The board's made it clear it thinks the interest rate path that will best bring inflation down in a timely manner is uncertain. And so they've not wanted to rule anything in or out with regards to interest rate changes. We're in a better place than we had been. Inflation's come down a long way. It does look to be moderating, but the path, according to our forecasts, is a gradual moderation from here. Labour market pressures, they're easing. They're still tight, but they're easing, and that's because growth's slowing, and so that brings demand into a better balance with supply. So all those things are in place. Our central forecasts are sort of predicated on sort of further good things happening, including productivity growth, but there's a lot of uncertainties around that. And I think the key point is those are reasonably well balanced as best we can tell, and because of that, the path's uncertain. The next rate change, don't know if it's higher, don't know if it's going to be a lower interest rate.
When you talk about the inability to rule out shocks, right? How much of those risks do you worry about that might be external, that might be geopolitical, that might be election-driven, the policies of other countries, and how much of it are sort of domestic, maybe structural macroeconomic aspects that perhaps we haven't seen in the data sets yet?
I think it could be both. We just don't know. But I mean, as a small open economy, we're always subject to developments offshore. We've talked quite at length about what's happening in China. China's a major export market for us, and there are concerns there about their property sector and the problems that they're trying to deal with there. So that can have an impact on things like the demand for our key commodities like iron ore, and that can move our economy around. But equally, domestically, things can be moved by what people here in the Australian economy are doing, particularly households at the moment. How are they going to behave in the future? That will sort of be a key point for where the economy goes.
Christopher Kent there, Assistant Governor at the RBA, speaking to us earlier. Well, let's take a look at how we're headed into the Tuesday session across Britain, Europe and the US. Of course, we're coming out of an Asian session that saw the Hang Seng up 2.4%, a really genuinely strong session for Hong Kong after being on a long weekend and also some down sessions last week. The yen also not hurting matters. It's 151.75 right now, so it's well away from the 152 mark, which is the next mark that traders seem to be watching, although it is just a little bit random. There's no telling where there would be intervention on the part of Japanese monetary policy or ministry officials. Brent crude, a little strength today. We are potentially seeing an escalation of hostilities with an attack on Syria, which killed some Iranian generals. We have Brent crude at 87.81. S&P futures are pointed to a lower open, though we are a few hours in advance. This is Bloomberg Daybreak Middle East and Africa, our top stories this morning. Strong US factory data pushes markets to rethink the number of Fed rate cuts this year. Odds of a June cut dipping below 50%. Iran says an Israeli strike on its embassy compound in Syria killed 2 military generals. That's as Israel agrees to in-person talks with the US over an invasion of Rafah. And Turkish President Recep Tayyip Erdogan suffers an historic defeat at the ballot box. Support for the ruling party now at its lowest on record amid high inflation and borrowing costs. It's just gone 8:30 a.m. across the Emirates. I'm Bonnie Quinn in Dubai, and let's have a look at how we're shaping up after what's been a really eventful couple of weeks, I have to say. US futures look to be pointed lower very many hours before the session starts. We did a very mixed and muted session yesterday. The S&P 500 ended down 0.2. The Nasdaq 100 ended up 0.2. This after very strong manufacturing data really surprised traders and market participants because we had 16 months of contraction, and that suddenly turned into the first month of expansion. So what does that mean for the Fed? Can it cut? Can it cut as soon as it was perhaps previously thinking? What will the Fed chair say on Wednesday? These are all questions going through the market's mind. The 2-year yield has repriced. We're back up to 469.07, back to the highs of the year. And then continued geopolitical uncertainty has Brent crude now approaching $88 a barrel. Let's flip up the board and see how things went in the Asia session. For the most part, it obviously continues. We do have some holidays this week. The Nikkei 225 down 0.2%. It was down 1.4% in the Monday session, so that's 2 days of declines now for the Nikkei. One of the beneficiaries, potentially, the Hang Seng, although that is coming back after a long weekend as well, and we are seeing some nice stories taking that index higher, including Xiaomi with its orders for electric vehicles, and that has that index up 2.4%. The Shanghai Composite, not perhaps as enthusiastic, but we are still seeing a positive session across most of China. The yen bears watching. We're at 151.73, so we weakened, but we seem to be holding at that level. 152 is a level that traders are watching for potential intervention, but as Mark Cranfield earlier said, why would it be 152? Could be anything. And then I just want to point out this U.S. manufacturing chart, because you can see there the contraction, the number of months of contraction, and suddenly this rebound back above 50 into expansion territory. What does it mean for the U.S. economy? What does it mean for the Federal Reserve and for global central banks? Well, let's ask some of these questions to our next guest now. Joining us on set here in Dubai is Anita Gupta, Head of Equity Strategy at Emirates NBD. Anita, thank you so much. Perhaps we could start there, because we did suddenly get this surprise, expansion in U.S. manufacturing. That economy is not slowing down. What does that mean for a cutting cycle and when it might start?
Good morning, Vinny. So what we are seeing is that there is a strong domestic push within the U.S. Domestic consumption stays very strong. Now that, of course, with the manufacturing data that came out yesterday with its definite expansion territory, and that seems to be a global phenomena. China also came out with strong manufacturing data. So whatever we feel about markets at this point, that especially in developed markets, we've seen this rally, 10% in the US, a bit more in Japan, a bit less in the Eurozone. Consumption seems to be still strong globally, and as long as that's there, we're going to see markets rally or at least hold these levels. Now, coming back to the US, it's, of course, the stimulus that came in through COVID times is going to be shrinking away. So that data is still not there. Hence, we expect markets to be resilient.
Yeah, so if markets are resilient, do you pick the same places that have been performing well over the last year or two? I mean, do you stay with tech, and do you stay with, some of the other growth sectors as opposed to rotating into value, as some investors have been saying?
We stay with growth for the simple reason that share prices are completely dependent upon earnings growth, upon profits. If you're going to be getting that earnings growth out of tech and healthcare, of course, at reasonable valuations. You cannot be at a very exponential valuation and then expect the company or the stock to continue, going up. No, that's not going to happen. But as long as companies give good guidance, we are getting the Q1 numbers very soon in a week's time. And when that starts flowing through, that's going to be the next catalyst for the market. Yes, we stay with tech, but selective tech, very profitable companies, very conscious of what's going to work. And, as we say, and it's pretty commonly said that, in the short term, you tend to overestimate what technology can do, and in the long term, you underestimate. So we are in for the longer term winners. And we do like healthcare, we like anything to do with obesity, we like anything to do with the impact of AI in diagnostics. We also like energy right now.
Energy. Well, tell us a little bit more about that. What kinds of energy companies?
Of course, the exploration companies, so anything to do with the big explorers globally, whether it could be Saudi Aramco in Saudi Arabia, it could be Exxon, Chevron in the US, BP, Shell, just to give you, an example of what, are the big. We also, like, anything to do with gas at this point. So, again, we're thinking that, gas is a beneficiary of what's happening with AI, also a little bit of the green revolution. Energy companies, also lots of them have great dividend flows, and not too many of them are going big into capex. So they've got that cash flow coming back to investors. Oil prices, Brent is about $87 this morning futures. So I think that trade should play off into this year.
Moving into this region a little bit more and emerging markets more broadly, there was a theme in the markets yesterday, and it could be continuing today. It's, difficult after one day to know what's actually happening, but that perhaps the Japan trade might be coming to an end and that China might be a beneficiary of that. There's also the idea today that India might be at an end and that China might be a beneficiary. What say you?
Okay, so we are looking at fundamentals here. China's growth is forecast to be around 5% GDP. India is still at between 6.5 to 7. Japan is coming out of a deflationary phase. Now, ROE in Japan is still low by standards if you look at India, if you look at the US. But we think that with the yen being low, exporters are still benefiting in Japan. We are still overweight Japan. India, we stay overweight for a long-term secular perspective, not just immediate short-term gains. On China, we've always said that we're going to see that spike. We're going to suddenly see equities start to perform. And now with the recent manufacturing data being positive, more economic data points coming up, you could see that rally. However, on a longer-term strategic viewpoint, we still favor India and Japan.
You could see that rally in China, but why should one data point suddenly convince investors when, activities from the central bank, from the PBOC, from monetary authorities, all sorts of efforts to, let the economy sort of do its own thing haven't worked for investors so far?
Absolutely bang on out there, because we are still neutral China. Okay. So what we are saying is stay invested in China, be market weight only, but we don't have to go overweight China right now. We're still waiting for further stronger catalysts that could be longer term. And of course, what in China, some things work, some things don't. Electric vehicle industry seems to be working. The real estate sector is not working.
Yes, it's a monolithic economy, and we can't really sort of put one label on it. Thank you so much for joining us, and particularly in studio today. Anita, much appreciated. That is Anita Gupta, Head of Equity Strategy at Emirates NBD. The chairman of Investcorp International says the firm is still bullish on the US. Mohammed Al-Ardi spoke exclusively to Bloomberg's Manus Cranney about investing in infrastructure in the world's largest economy. Have a listen.
When you look at the global economy and you see what markets are there, I think the US is the big game in town. There's growth. We continue to see a lot of opportunities. I think it continue to innovate, and so we are really bullish on the US market.
Now, you're sufficiently bullish to have already joined in on the renovation, as I say, of JFK. It's the joint venture with Crossair. Is that a bullish call on international travel? Is that a bullish call on infrastructure? Or where do you want to deploy more in the US in that JV?
So I think infrastructure, a few years ago was not really, hot. But infrastructure now, I think, is really becoming very important. I mean, if you go around the world, you see a lot of governments are spending, are offloading a lot of these assets because they want to develop their infrastructure, they want to build their airports, and so our JV with Corsair is really in that sense. It's also it's an asset class that investors like. It produces long-term yield and good returns.
Obviously, we're dealing here in this country with the Francis Scott Key Bridge, the collapse, the tragedy around that. That's going to shine a much bigger light on infrastructure here. Do you think it will accelerate the investment case? It's tough to talk about a human story, but it will throw perspective on this infrastructure need in the United States of America. What kind of scope will that deliver for us?
I mean, I think, when you talk about competitiveness in this global market, infrastructure plays a really big deal. And of course, I think the US is a big market for that. And, all the regulation and all the bills that are pushing for better infrastructure is a great opportunity for us.
And that was Investcorp International Chairman Mohammed Al-Ardi speaking to Bloomberg's Manus Cranney. Plenty more still ahead. Do stay with us. This is Bloomberg Daybreak Middle East and Africa. Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Vonnie Quinn in Dubai. Just a quick word out of Thailand. Thailand is widening its 2025 budget deficit by $4.2 billion in order to boost the economy. Now, if you look back, fourth quarter growth in Thailand actually missed by a substantial amount. 1.7% it came in at. And economists in our survey were looking for that to be 2.6%. So Thailand has been lagging growth-wise. Well, now this announcement that Thailand will widen its 2025 budget deficit by $4.2 billion in order to stimulate the economy. Meanwhile, Kenya's annual inflation eased to a two-year low after the currency's world-beating streak helped rein in import prices. For more on this story, joining us now is Bloomberg's Ondiro Oganga. Ondiro, what factors have contributed to the slowdown in consumer prices?
Vonnie, we are seeing several things contributing to this ease, one of them being a steady decline of prices of food, transport, water, electricity and gas prices over the last year from 2023 March to 2024 March. Other factors also include great weather. Kenya is anticipating heavy rainfall, and this should be good for agricultural production and also boost hydropower production, easing prices of food and also electricity moving forward. The government has also set aside money for subsidizing fertilizer and seeds, which again is meant to boost food production. But most importantly, they've also cut gasoline prices by 3.5%, meaning that transport costs have gone down from 10.8% to 9.7%. But earlier on in the intro, you mentioned the Kenyan shilling. It's been steadily gaining against the dollar, and this has eased a lot of prices because Kenya is a heavy importer of both food and non-food items.
Ondiro, talk to us about the significant gains of the shilling as you have been, and you know, what's behind these gains?
The most dramatic gain in East Africa, so to say. We saw the Kenyan shilling take a beating for the last 4 years against the dollar, but in the last month it has appreciated massively against the dollar. If we are to quantify it, 19%, and it went from a low of about 165 Kenyan shillings to the dollar to trading around 130, 132, maximum 135. And this is absolutely great news for Kenya. And some of the reasons behind this gain include, one, the new Eurobond issue of about $1.5 billion that was used to repurchase the Eurobond that is due in June. So that elevated the fear of a default. Kenya also put out an infrastructure bond that was valued at nearly $500 million. But most importantly, we've also seen that the Central Bank of Kenya has hiked its rate to a total of 250 basis points. So this has helped tighten the conditions in the country. And because of this ease in inflation, we are likely to see that the central bank could be persuaded to hold their rates at about 13% tomorrow when they meet.
All right, we will keep an eye out for that meeting and the results. Ondiro, thank you so much. That is Bloomberg's Ondiro Oganga there in Kigali. Meanwhile, South Africa's main opposition party says it will resist forming a coalition with the ruling ANC in order to govern the country, should it need to. General elections are scheduled for May 29th. Democratic Alliance leader John Steenhuisen spoke exclusively to Bloomberg's Jennifer Zampasaja. Have a listen.
We have already got a pre-prepared agreement about how we're going to work together, how we're going to stabilise a coalition, and how we're going to make sure it governs effectively.
Why not just have one single party ruling the country? I mean, is it because of the past 30 years of the ANC? What is it that you're so opposed to?
I think that if you look in South Africa, people are very brand loyal to organisations and brands. It would be, I think, foolhardy a year before an election to form a totally new party and expect it to get the name recognition and the traction.
I mean, we're seeing a lot of new parties.
We are seeing a lot of new parties, and we're seeing the fact that they're not making the breakthroughs that people would expect them to, precisely because they're unknown quantities. We're hoping that the multi-party charter, the whole, is going to end up being greater than the sum of the parts. The IFP can go on the hunt for votes in rural KwaZulu-Natal. The Freedom Front can bring votes in from rural parts of the Northwest and those communities. The ACDP can bring in the religious voters, and to bring all of those to the table to form a big pile of chips that can be used to be able to form a government.
What about the DA and the ANC?
No, we don't want to be in government with the ANC, and that's precisely...
So that is out of the question?
No, it's precisely why we formed the multi-party charter. My job is to get the ANC out of government. I don't think we're going to solve the country's problems by having the same people who are responsible for the economic crisis, the social crisis, and the infrastructure crisis sitting around the table. We've got to change them, and that's why the multi-party charter has said we will not do deals with the ANC or the EFF.
What if we see a scenario where the ANC still is somewhat in the majority? Is the DA going to rule out working?
We will go back to the multi-party charter, and we will decide on what the best option for it. It may be a minority. Maybe we could form a minority government as a multi-party charter. I just think there's too many unknowns at this stage to say it. My focus is on getting the ANC way below 50% and getting a new set of people around the table so we can get our country off this low growth, high debt, high unemployment trajectory.
South Africa's Democratic Alliance leader John Steenhuisen exclusively speaking there to Bloomberg's Jennifer Zapasaja, and you can see more of that interview, plus plenty more about the situation on Africa Amplified. That's coming up April 5th. That's Friday at 9:30 a.m. Dubai time, 6:30 a.m. London time. Plenty more still ahead. This is Bloomberg Middle East and Africa. Welcome back to Daybreak Middle East and Africa. I'm Bonnie Quinn in Dubai. 2 years ago, Dubai became a hot favourite with Russians looking to park money or build new lives after President Vladimir Putin's invasion of Ukraine. That allure is now dimming, and many Russian arrivals are looking to move elsewhere. Joining me now is Bloomberg's Nicolas Parisi, and he wrote the story. So, Nicolas, what are some of the reasons that Russians are suddenly now reconsidering Dubai?
Well, the reasons are twofold. First is the cost of living, which ironically they helped drive up by coming here. Real estate prices obviously went up, as everyone has noticed. There's also the school costs, for example, that they have taken into account. But more importantly, the local banks have become more stringent in enforcing U.S. sanctions on Russians, so it becomes more difficult for them to operate here. And so since then, they've been contemplating other regions or even returning home, for that matter.
Well, so the UAE had been trying to desperately get off this so-called grey list, and I'm wondering if that's why the banks suddenly became more stringent.
Well, they got off the grey list very recently. And obviously, there was a success story. They've put in a lot of effort in getting off that list. So obviously, expectations, they want to stay off that list at all costs. And that means enforcing these sanctions and making sure that Dubai is not seen as a money laundering hub, for example.
Where are they going instead? Where is the next spot for this?
Some might go home. Some are going to Asia. We've also heard Europe. Some might also stay here, right? I mean, the idea of the story was not to say that there's a mass exodus of Russians. Some have built businesses here, built their lives, and some are expected to stay.
Yeah, absolutely. And then what does it mean for real estate prices if even a small number of people leave?
Well, they were in 2022, they were the top buyers of real estate. So as I said, they certainly help fuel those real estate prices that we've seen. But there are already buyers to take their place. Indian buyers, for example, they're already traditional buyers here, but also Chinese. The chairman of one of the biggest developers said that Chinese are increasingly taking over. So I wouldn't expect an immediate drop in real estate prices.
It is a really fascinating story, and I'm curious as to, whether this continues and if it's really only just Russians that are leaving, or are other people leaving too for many of the same reasons that you suggested, like cost of living, school costs?
I think Dubai has always been a transient place. Obviously, the authorities have tried to address that issue. So we'll see people coming in and people leaving. But at this moment, it's such a hotspot for people globally that the new arrivals tend to still outpace the people who leave. So net, I think we're still in an upward cycle.
Yeah, because the current region, including Abu Dhabi and so on, continues to attract numbers of hedge fund managers and portfolio managers. Nicolas, it's a wonderful story. I would encourage everybody to read it. That's Nicolas Parisi joining us here in Dubai. Well, here are some of the latest corporate stories we're tracking. Tesla may be headed for a gloomy sales milestone as waning demand for electric vehicles and elevated interest rates take a toll. Analysts have rapidly lowered projections for this week's quarterly deliveries report, with some even braced for a first decline since the early pandemic. On average, analysts think Tesla delivered 449,000 vehicles. That would be down more than 7% from its record fourth quarter. Bloomberg has learned that Tiger Global has raised about $2.2 billion in its latest venture capital round. Sources say the total falls well short of projections for $6 billion and is its smallest fundraising haul in a decade. It's also the first time a Tiger venture pool attracted less cash than the previous one. Nippon Steel has made a formal commitment on spending and jobs to the United Steelworkers Union. The agreement includes an extra $1.4 billion in capital spending, as well as a promise of no layoffs before 2026. Nippon Steel's new president has pledged to press ahead with the takeover. That's despite opposition led by President Biden, who says U.S. Steel should be just American-owned. Citigroup is said to have implemented a fresh round of job cuts in its U.S. investment bank last week. Sources say technology, media and telecom were among the coverage areas hit the hardest, with senior bankers and junior roles affected. The cuts come as Citigroup says it has concluded the major actions around its reorganisation plan. Those are some of the corporate stories we're watching. We are also watching futures in order to tell us which way this market is headed this Tuesday session. Equity futures in the United States look to be pointed very, very fractionally lower. Several hours to go, though. That's not the case. Yesterday we saw futures pointed quite strongly higher, and then we had a very muted session in the end, with the S&P ending up down 0.2%, the Nasdaq 100 ending up 0.2%. Manufacturing data really put a spanner in the works for many. 16 months of contraction followed by suddenly expansion. So what does that mean for the Fed? Well, markets are continuously trying to price that in. Euro Stoxx 50, well, that looks to be opening higher in just a couple of hours. However, again, we are early going. Let's take a look at Treasuries, though, because we saw a massive move in the curve after the manufacturing data came out. Don't forget, the Fed had been urging patience all last week. From Chris Waller to Fed Chair Powell, they'd all been saying we need more data on inflation in order to be comfortable starting a cutting cycle. We're going to hear from Fed Chair Powell Wednesday as well, and then, of course, the all-important jobs data Friday. But as you can see, a good 10 basis points there across the curve. Thanks for joining. This has been Bloomberg Daybreak Middle East and Africa.